subscribe now and press the bell icon. Never miss an update.
Okay, so we'll start the next unit under this chapter. First one is higher education deductions. I think we recently spoke about it. Some $2,500 of interest paid on educational loan and all. How can they be deducted if there is any limit on it and all? So, anyways, there's a limit of 2,500. This limit, I mean, this is called student loan interest deduction. We are talking about all above the line deduction. So, if there is an educational loan taken, then the interest can be deducted, but obviously there is always a cap on it. So, what they're saying is max 2,500, and your AG, your AGI should be in this range or below for different category of filers. Okay, Muskan, please read this thing. 1 minute, we'll just go over this. Hold on. Now, let me just finish the tuition thing and all. So, this is about interest deduction, the student loan interest. Now, obviously the loan or educational expenses, they have to be used for the correct expenses. And what they're saying is the qualified expenses that can be included are room, board, tuition fees, and all other necessary expense, even including transportation. So this is only for loan interest deduction. But usually room and board are not included if you just go with tuition fees. There's something called 1098T where we can get a deduction even for tuition fees paid. There they would not include room and board because it's like that is not directly related with your tuition expenses, or that's very subjective, or people may go and just get a very expensive room and all and maybe try to get that expense deduction. So for tuition and fees deduction, I don't think room and board are included there. But obviously anything related to tuition fees, books, supplies, equipment, they're all included, whatever category we are looking at. Tuition and fee deduction, that's also very, very common. Most of our clients, kids, they're going to US schools and all, or colleges, and they will always tell us that I have paid so and so for my son or daughter and all. We should always run this to see whether we can claim any kind of tuition and fee expense deduction. Or there is something called American Opportunity Credit. And there's one more, what is the other one called, Tanya? The Hope Scholarship Credit.
Lifetime credit
or something, yeah. So those are the three options. Either we can go for direct expense deduction, or they might be eligible for certain credits. Let's not get confused. We are talking about two different things. The first part was only for the interest paid on any student loan or any educational loan. Now, the second part is talking about, forget about interest, principal and all. Second part, what they're saying is you can take a tuition fees deduction if tuition or educational expenses are paid for higher education. We saw that last time. The school education, primary education, secondary education is not covered here because that's all provided for free by the government. It's only when the kids go to colleges, that's when they have to start paying, and that's where IRS is saying that fine, we'll give a deduction. Why? Again, this is a merit good kind of thing. If you remember all the economics that we have read earlier, there's something called merit goods and demerit goods. So these kind of deductions, these kind of benefits are given for the expenses which does something good to the society. Obviously, education has to be encouraged. Okay, so there is a limitation to that you can take only up to $4,000. Plus, there is going to be a restriction on the AGI. The AGI doesn't have to be above certain range. And what is it and all? Again, you can just take an idea from here. But typically, most of our clients are going above $160,000, so they may not get it. Between this range, they may get partial credits. And below this range, they may get full credit. So a lot of times when we get the tax returns and the client would come and say, well, I have this, tuition expense and I want to claim, I've paid a lot. Maybe I've paid like $30,000, $40,000 every year I'm paying. I should definitely get some tax break. We need to be able to run that number. We need to be able to, when we put in the software will do all these calculations, right? What AGI you're falling under, whether it's allowed, not allowed, and all. But we need to be able to communicate that to client that this is what the rule is. You have already crossed that AGI limit. Your income is higher than what IRS is saying, and that's why you're not allowed for this credit or a deduction. Okay, or they may say, well, last year I got $2,000. This year you're saying only $1,000 I'll get benefit. And also we need to know all these rules, why this is happening. It's nothing magic is happening there, right? Everything has a logic. If there's something we are putting in the software, it's not giving the number that we are expecting, then maybe we need to go and check. Maybe some other limitations are getting triggered. So there are certain, what is for tuition and fees, if they come and say, well, I have paid $30,000 for the tuition, on top of that I paid $2,000 every month for my kids or son or daughters, whatever, room and boarding and all. So maybe $24,000 a year I'm paying for that, and I'm paying for transportation and other stuff and all those things. Or maybe I got furniture because my kid who is studying there, they probably need a table or chair or the lamp or something. Those are not allowed for this deduction. This is strictly for fees which has been paid to a college. Books are definitely included. Books is something, that's reasonable to say that books are required, but do you definitely need to have a $2,000 room, like per month rent of $2,000, or can you adjust in $200 per month, or do you want $5,000 per month? That's all again very, very subjective. Rich kids may want to go for a luxury place, and the other ones they may just be okay with the college dorms or something. So what IRS is saying that we are not going to give any deduction for room and boarding expenses and all. It's strictly only course related books. Yeah, so it's not even we go and we keep buying some different books which are not related to course. What courses have been taken? If you're an art student, obviously any book related to art and all that should be fine. Or any equipment related to art. Maybe some board or easel or paints or whatever. Those are okay. So there has to be a reasonableness. We also need to use our own judgment and see whether that's eligible or not. Obviously, some of the expenses are going to be ineligible if they are paid with some assistance or through scholarships. Because if taxpayer is not paying out of their pocket, it's not even fair for them to ask for a deduction. So those are excluded. Now 1098T, T stands for tuition. That's very important form. So that's a very important form, and we will see this form quite often when we are doing the tax return. Okay. They are not talking about American credit or lifetime credit and all, but then American opportunity credit and lifetime education credit and all. They're not talking about that, but those are also something we can consider. Due to the phase out, because his income, first of all, we have to see what is the status. If this guy is single, so the limits are obviously low for single people. If they're married filing jointly, then the limits are high. So they're giving the phase out range here. For single, it's only 70,000 to 85,000, and his income is 145. So he will not get a deduction, even though whatever he must have paid doesn't matter. So again, this is very important from tax planning perspective. When the client, they will come and ask us, I'm planning to take a loan, I'm planning to pay so and so. Do you think I'll be getting deduction? Or we can also tell them that, if you're talking to them and something of this topic comes up, We'll tell them, like, before you take any loan, and if you're thinking that it will give you some benefit and all, just give those numbers to us. We'll run it for you and we'll let you know. Okay, a lot of times, and this is very, very common problem. A lot of times they come up with high expectation. Oh, I've paid so much in tuition, I will definitely get a break. But they don't understand that their income is also pretty on high level, so they may not get it. Maybe they can plan it in a way. Maybe if they're having a lot of capital gains, don't book capital gains. Make sure your income is not going above certain point. Okay, or if they have losses that they can book, then maybe they can do some loss harvesting. Okay, so a lot of planning can be done if we know about these rules. So that's all about education expenses. Now there are some other, like, I think majority of the above the line deduction we have covered. Those are the main ones. There might be some small ones here and there which we can see. That then performing artist, if we get a client who is an artist and all, there might be dancers or singers or something else, musicians and all. So they can they definitely get to deduct the employee business expenses, the unreimbursed expenses, which has been repealed for everybody else. Other people don't get it anymore, but for them, they have still kept this provision that they may be able to claim those expenses against their taxable income. Again, if their AGI is not more than so and so. If the AGI is very high, they don't get any benefit. Then there are some moving expenses. This also we have seen it earlier, so let's not spend too much time on it. The moving expenses clause has also been repealed. Now nobody can claim moving expenses. Up to year 2018 or 19, it was very common for taxpayers to claim up to $5,000, $10,000 as moving expenses and all, and IRS was giving all that break. Now what they've done from 2017 onwards, I think 17, maybe before 17 they were deducting it. Yeah, so from 2017 onwards, they have completely taken out that benefit, and they said that only military people will get this. Okay, because they have to move from one place to other, and there's always a soft corner that they have for military people. So penalty on early withdrawals of saving, this is not retirement saving. These are all like CDs or FDs that we talk about. CDs are called FDs is fixed deposit in India. They call it certificate of deposit. CD is the term that we'll use in US. So if there is any early withdrawal, and if obviously bank may charge some penalties, some interest, some kind of charges and all, those are all deductible. So that's fine, because this is not retirement saving. Retirement saving has very, very strict rules. Only in certain conditions you can withdraw the money. You cannot just go and break into your retirement account and take it. Otherwise, be be prepared to pay 10% penalties. Then there's something called Archer MSAs. Again, this is not very common. HSAs are very, very common, not Archer MSAs. MSA is also some kind of medical saving account, and they are usually for individuals who are self-employed or employed by a small employer and who are covered by a high deductible health insurance plan. So what is high deductible? Meaning when they go to the doctor or when they go to hospital, there are certain plans where they say that every time you visit a doctor, let's say their consultation fees is $300 or $200 or $500. So deductible is something that the patient will pay out of pocket. So what they say that, okay, your deductible is only $25. You pay $25, you get a consultation. Rest of $275 will be billed to insurance company. So that is a reasonable plan. Paying $25 is fine. But if some kind of high deductible plan they have enrolled into, and which says that, okay, every time you go to a doctor, you have to pay $100. That's pretty high as compared to other standards. So those are called high deductible health insurance plan. Usually people, those who are self-employed or those who don't have those who are employed by small employer, they don't get a lot of benefits and all, and they are not in a position to negotiate it with insurance companies. So in order to make sure their premium is low, they will go for high deductible plan, right? Otherwise, if they want to make sure their deductibles are low, they'll probably have to pay high premiums. Somewhere the other way, it has to be balanced. So for them, IRS is saying there's something called MSA plan, and you can put in some amounts in there. They'll be tax deductible. If you're using that to pay medical expenses. And any earnings generated are also not taxable. So if you are putting in, say, $5,000 every year, after 10 years, it became like $60,000, $70,000, because there, again, all these plans will have some instruments attached to it. It's not like you're just putting money into something which never grows. It will give you a lot of options. It will probably give you a list of 200 different mutual funds. That's how US industry work. All the retirement plan also, they go to simple brokerage account. Like provident fund, we don't have any option, right? We just put in there. We cannot move around the money. Whatever government wants to pay interest, we'll take that. It doesn't happen like that in US. There's full freedom and flexibility given that, okay, if you're putting money into, say, 401k Fidelity account, then you may get these 100 different mutual funds that you can invest in, or you can even directly buy equity, or there are certain other bonds. It will give you a full list, so the person can go there and pick and choose how much money they want to put into which equity or bond or fund. And so it may grow, it may even, like, it may also be incurring certain losses and all, which is fine as long as the money is not going out of that account. IRS doesn't care, and there is no taxes on unrealized gains. The money may be growing there. If you're putting $100,000 in 401k, maybe the stock market really went high that year. Maybe it became $150,000. So there is actually, on paper, there is a gain of $50,000. And you may actually, not just on paper, you may actually book that gain by taking out money from that particular fund, and you put it into some other fund or any other simple, like, bank account kind of thing, where you get only 1 to 2% interest. So if you sell off that fund, take the money out, in a way we are saying that we have booked the profit. But those profits are not taxable because the money is still into 401k account. Okay, so those are all, they might be realized. We cannot say those are all unrealized gains. They may be quite realized gains also, but those are not taxable. Okay, and again, there are certain conditions for MSA and all that. If you're under age 65 and you're taking out money out of that, which is not used for the purpose for which it has been created, then there's some 20% taxes and all those things. And it is also limited to 750,000 people. So again, IRS will decide. This is something like, the one who goes and signs up fast, they get this program. Usually, all the employees will get the health insurance from their employer, or at least the kind of clients we have, because they're all working for huge companies and all those Fortune 100, Fortune 500 companies. So usually this is not applicable to us, but we should be knowing if the person is self-employed, then there's something called Archer MSA available to them. But there are certain conditions. They have to have a high deductible health insurance plan. Jury duty return to an employer is deductible by the employee from gross income. So jury duty pay, there's something called jury duty, and you guys might not know about it. So there's like, the way US courts work is, or I don't know if you're watching any Netflix series and all, you will see this word a lot. Like, the jury has been called to to give their decision or conviction about certain case in court and all, especially for criminal cases. So jury is like all that some common people, they'll call 8 or 10 people randomly from anywhere. It could be a retired person, it could be a sports person, or it could just be a normal employee somewhere, and just randomly call people, and they're not even related to any, they don't have any legal background and all, and they call them in the court and say that, okay, for this case, you have to go through all the case proceedings and all court proceedings and then give your judgment. And whatever jury decides, mostly judges will agree to that. That's a very, very different way of how US courts work and all. So anyone can be called for jury duty. So if I'm there in US, someday I'll just get a letter from US court or high court or district court or something, and saying that, okay, this is the date, this is the time given, you have to come for jury duty. And it's mandatory to attend that. You cannot say no to it. Obviously, if you're sick or if you're out of the country and all certain those kind of reasons, we can always tell them that it's not possible. But typically, people don't say no to it because that's required by law. So there could be some pay which is related to jury duty and all those things, and those are all deductible by the employee. Then any expenses from the non-business rental, they're not deductible. Obviously, if it's like if you're not even putting the rent for the purpose of business or for the purpose of taxes, then any expenses are also not deductible. Any questions on this part? Other above the line, what we have seen is them artists and all, they get some kind of deductions. Military people may get some deductions. Then if you're doing early withdrawal of your deposits from bank, you may get some deductions for the charges that you end up paying because of the early withdrawal. You're like prematurely, you're breaking your FDs and all. There's something called Archer MSA. Again, it's a kind of saving plan. That's it. And then there are a couple more small points like jury duty and the non-business rental expenses. Any questions on it? Important. This is really important. Loss limitations. The name itself says that certain loss are limited. We cannot take all the losses as a deduction on our tax return. And if we cannot take them, they either we lose those losses or they get carried forward. There cannot be a third way out. Either IRS is like, either if there are some categories where we may completely lose the loss, that okay, whatever you can claim, otherwise we are not allowing anymore, and that's fine, you just lose rest of it. Or it gets carried forward. Getting it carried forward is more common. But there could be some gambling losses, there could be some hobby losses, they get offset only against the same kind of income. And it's not like we can get them carried forward to next year. But usually there could be rental losses or any other passive activity losses which will be carried forward. So now the loss, again, this chapter could be a bit complicated. So it's not that simple and easy. We need to pay a little bit more attention here. Okay, there might be certain terms which may be very new to you, but let's try to understand. The loss is limited. They're saying there are 3 points that we need to understand. The loss is limited to the amount of taxpayers' basis in the activity. Okay, what is the basis? That means what is that you have put in. If you're a partner, what is your capital that you have put in there? If you're a shareholder, what is again your share of capital there? So that will tell us the basis. Or if you're buying a property or something, what is the basis that you're buying it for? So the loss, they are not saying the loss will not be allowed. What they're saying is the loss is limited to the basis in the activity. And we will go through some of the examples that will make it clear. Then we have to look into at-risk rules. What is meant by at risk? Like how much of our money is at risk? If I'm starting a business, I've put in $100,000. That $100,000 is at risk because it may, the business may go very well. It may take off very well, or it may just result into losses. So all of that is at risk. And any of the passive activity. If I'm starting a business, probably it's not a passive activity because I'm fully involved there. But if I'm going out and buying a property and putting it up on rent, that could be a passive activity, because maybe when the tenant comes, that is the time you get involved, and maybe like, some regular checks and all, but we are not actively involved in that. It's not like actively we are going every day, we're going to the tenant's place and say what's going on and this and that and all. No, that. But when we are running a business, we are probably actively doing it every day. We go to the office, or we get on calls, or we visit customers, or we do their work. So there is a difference between active business and passive business. So we'll go over this example now, and then we'll see what is the at-risk rules. Okay. Who wants to read it? How about you, Tanya? You can also explain it.
A taxpayer who owns both a lumber business and a boat for personal use incurred two losses during the tax year upon selling both the boat and the lumber yard to a colleague. Though the combined loss totaled 10,000, only the portion attributed to the business is potentially deductible. Losses on sale of property held for personal use are not deductible.
Yeah. So, what are the two different kind of losses here?
Business loss and personal loss.
Correct. One is that he's running some lumber business, and then he's selling a boat which was for his personal use. He's not using that boat for commercial purpose. Okay, so we need to be, the combined loss is this much, but IRS will not allow them to deduct the entire loss. The business loss is definitely deductible, potentially fully deductible. Again, they're using word potentially because there might be certain conditions which may not allow it, but generally it is deductible. But losses on sale of property held for personal use are not deductible. So we'll, even though the total loss is 10,000, we'll have to see what gets deductible, what not. Okay. Let's look into at-risk rules. So let me read this. The amount of a loss allowable as a deduction is limited to the amount a person has at risk in the activity from which the loss arose. So usually we have to see what is that amount that has been put at risk in that particular activity. This is again very important because this is all related to K1s. When we receive K1 from S corporation, LLCs, or any pass-through, entity, business entity, at-risk rules will come up. There is a small checkbox that you see while entering K1. If you put at-risk check mark or basis check mark, what does the software do is it will go and first check what is the amount at risk. If it has something carried forward from last year, or if you have put it properly, and then the amounts may get limited to that. Same thing, there's a little checkbox there. If you put mark it as passive activity, the loss may get limited. Or we can put basis limitation. Again, there's something called basis limitation checkbox. So when we do the returns, that time, like if you're looking into any K1 from a S corporation or LLC, you would see all these names written there. What essentially should come to our mind that, okay, there is a possibility that if the K1 is reporting a loss, there is a possibility that the entire thing may not be deductible. Now, what is the ratio that they come up with? What is the calculation behind it? What is deductible? What is not deductible? That is something different. Okay, but we cannot assume that if the client comes and says, well, here is my K1, you know what, I put money into some business, I had some, or maybe in some investment scheme or somebody else's business, and I am having huge loss, like I put in $50,000, everything is gone, and here is the K1, it is reporting all that 50,000 loss. I should be able to take all that as deduction, and maybe my other income of 100,000 will get reduced by 50,000. And so my tax liability should be really low. That's what the client is coming with the assumption. We cannot tell them, yeah, you're right. That's what it will work. That's how it may work. We'll have to tell them that we don't know. We'll have to first look into K1. What are your limitations if there are going to be any loss? Quite possible that an entire 50,000 loss, may not get offset against other income, or maybe only 10,000 you can offset and you can reduce your other income to 90,000. So don't go with that assumption that you will, if you are having a loss, you will get like entire break on it. Okay, so you may still have a liability. We are not saying that the loss may get lost, or you will probably not be able to get any benefit out of it. No, it will get carried forward and all, maybe next year or maybe in the following years, one may be able to get benefit. So a loss, what is a loss? What they're saying, in any excess of deduction over gross income. We know that. Everybody knows that. I'm sure everybody sitting here will know that what is a loss. Expenses, when they go above the income, then it turns into a loss. That's a simple thing that they're talking about. These are all, when they're talking about partnership, LLC and all, they're talking about pass-through companies. Pass-through is something, the name says, passing through. It passes through the 1040 return of the shareholders or the individual income tax return of the shareholders. So there's again a distinction. In India, the partnership pays taxes, partners don't pay tax. In US, partnership doesn't pay anything. Partnership will just file a return, give a statement to the partner saying that this is your share of profits or losses. And then it will get incorporated in the personal income tax return, and the partners will pay taxes on that, or they will claim losses. So that's called pass-through. That means the double taxation is avoided here. It's not like a general C corporation or any private limited company when they are also paying taxes, then the dividends are declared, or the income is passed on, then the shareholder also pays the taxes again. There's always two levels of taxation there. Right? But that's not the case with these pass-through entities. So partnerships, S corporations, LLCs, those are all pass-through. Okay. Then, so we have to see the at-risk rules are applied separately to each trade or business. Quite possible one person is a partner in 5 different entities. For every entity, we have to see what is the amount at risk, what is your basis, how much loss can you take. It's not like the other entity is having profit, this entity is having loss, just offset them against each other. It may not be possible. So what is the at-risk amount? Whatever the basis of the property contributed. The property could be real property, it could be cash, it could be stocks, it could be anything. When you're starting a partnership, all the partners will come up with their share of capital. Someone will say, okay, fine, I don't have cash with me, but I'm going to give my car as my capital, right? Like my car is worth so and so. So that will become partnerships asset. So that's the property that I'm contributing. Other may say that, okay, I don't have cash either, but if we are, let's say we are starting some business related to garments. They may say that, okay, I have a lot of all these rolls of clothes and all sitting there. It's probably worth some $50,000. I'm going to contribute that. Other person may say, I'll just put in cash. It could be all different kind of things that one can contribute. If money is not, if they're not contributing cash, the golden rule is look into the fair market value. What is the fair market value as of the date on which the property is contributed? And that becomes the amount at risk, or that becomes the basis. Okay. Are we clear until here? What is a pass-through company? What is meant by pass-through, Divyansh?
Ma'am, pass through where that is in the form 1040. The client we can pass that.
Okay.
And partnership does not have the pay tax, and partners will pay the tax, ma'am.
Good. Yeah. Good. So that is pass through when there is no double taxation. Okay. So that's the shareholders or partners, they pay taxes. Entities don't. And that's a good saving vehicles, right? We should always advise the client, go for a pass through entity. Why do you want to prepare? Why do you want to incorporate a C corp, show profits over there? First the corporation is paying tax, then you will take out money for yourself, you yourself will also pay tax. If it's a small business, no point going for C corp and all. It should always be a S corp or LLC. If you're looking into a very huge business, let's say they have some startup plans, they want to raise funds, maybe get some $5-10 million from VCs, investors, make it, make it go, or make it turn into a unicorn or whatever, then obviously we don't say that you mix up your personal and your business together. Because with pass through, the business and personal taxes are mixed up. But when we are strictly running something on a very, very large scale, let's not mix all that up, because the liabilities are also huge. There are a lot of other legal factors. So in those cases, we'll probably make it a C corp. C corp is a regular corporation, or C corp means private limited, if you want to understand in Indian context. And C corp can also be publicly listed, then it turns into a listed company. So but C corp, when we are doing C corp taxation, we don't need to look into this at risk or passive rules or loss limitation and all. Why? Because again, C corp is a separate entity. If it has losses, it will be its own losses. If it has profits, they are its own profits. They'll pay taxes on it. That's it. They don't have to distribute money to the shareholders. Nobody else's tax returns are being subjected to what C corp is reporting as a profit or as a loss. Okay, they're all separate. Shareholders tax returns are completely separate from corporation tax returns. But that's not the case with pass through. So that's why these things become important. Only when you're dealing with LLC, S corporation and all, like a lot of times when we do tax return, I always ask, did we do the basis calculations? Maybe if you did basis calculation, maybe all the losses that you're taking right now, you're reducing all ordinary income, they'll not be allowed. And we have done that many times. I mean, Shweta, Tanya, you would remember that. It completely changes the entire tax structure. So we need to be careful about this loss limitation, especially when there is a loss. If there is a profit, no problem. Like IRS is saying, well, there's a profit, go ahead and pay. Who cares? Only when there is a loss, they don't want the loss to get offset against other income. That's why they're putting up all these rules. Okay, so now let's look into two different things. One is called recourse debt. The other one is non-recourse. Again, those are important concepts, because when you're preparing the tax return, you may accidentally mark the checkbox next to recourse debt or to non-recourse and all. And you may not even realize it will completely change your tax return. Recourse debt and non-recourse debt, or will and recourse, again, those are all debts, so those are liabilities that we are talking about. Now what is the difference? Recourse is something where person is personally liable. So the recourse can happen, I mean, it could be recourse to their personal liability. So maybe the person has given a guarantee, maybe it's just not the partnership's liability. The partners are also responsible, or limited forget about partners. You will say that partners are anyways jointly and severally liable and all those things. That's what partnership is about. But what about LLCs? LLCs are limited liability company. The name itself says those are limited liability. The shareholders should not be personally liable. That's why they create LLCs. LLC is a simpler form. If they want to go a step further, they will create a corporation. A corporation is completely different. Then corporation may do a fraud and all. They'll come and they'll probably catch the directors or officers and all, but most likely they'll not go for the shareholders. That's not the case with sole proprietor or general partnerships and all. There could be limited partnerships, but not with the general partnerships. So recourse is something where a person's personal assets can also be like subject to risk. Okay, a person at risk amount includes amounts borrowed only to the extent for the debt the person has either personal liability or property pledged as security. Maybe they are getting a loan for the partnership, but one of the partner is very rich or influential or whatever. They said, well, just give us the loan. Okay, here is my, house. I'm gonna put that as a security. Don't worry about it. So that person now because of doing all that, it becomes a recourse debt. If the partnership cannot pay, the bank can go against that particular partner's property, which was pledged or which was put up as a security. So that's enough for us to remember. There are a lot of rules into that. If we go deeper into it, probably it will be a very, very lengthy section. But what we need to remember is something where personal liability can be attached. Non-recourse is something where there is no personal liability. The taxpayer is not personally liable. There is no recourse made to the personal liability. So it's just the company has to pay, and the entire risk is for the company. So now there is some exceptions here. One is that the taxpayer is not personally liable, but the financing is. It could be personally liable if certain of these transactions come into the picture. Like if you're taking a loan from an unrelated third party, or if you're obtaining a loan from a related party could be your cousins or parents or uncle, aunt and all, but on commercially reasonable terms. So if you're getting it from a related party, it has to be at arm's length, as they call it, or commercially reasonable terms. So still the taxpayer is not personally liable, but the financing is all. This could be a bit confusing, but what we need to remember is in the recourse debt, the liability can be attached to a person's personal assets as well. Non-recourse, nothing like that. But let's say when we are doing the tax return, we say that opening recourse liability is $100,000. Closing recourse liability is $50,000. That means $50,000, the loan has been reduced by $50,000. So the partners or shareholders, their risk is getting reduced by $50,000 because now they are not personally liable for the loan which has been paid. So what will that do? That will also impact the basis of those partners in the partnership. Because the money which they have put up as at risk has gone down. Okay, so it may have an impact on their basis. That's why whenever we are doing the tax return, we don't go randomly and do things and all. Everything has a logic there. So we need to understand what we are doing. Now, this could be, as I said, this is a bit confusing topic. This could be a bit complicated. You may not understand it completely, which is okay. But right now, the point is that at least you will remember the terms. And you will remember that these adjustments may have a impact on the basis of the shareholder. And that in turn may have an impact on the losses which can be used for that particular year. Because the loss limitation may come up by any of these combinations if we are putting there. Let's say the loss is like $100,000. The basis of a shareholder is only $50,000. They will not be able to take loss beyond that basis. So there is a clear limitation that, okay, 50,000 loss will be allowed, rest of 50,000 will not be allowed. Okay, it will just keep sitting there. Maybe next year, if your basis increase, you take further loss. If the amount at risk decreases below zero, previously allowed losses must be recaptured as income. So what it is saying is, if your basis is becoming zero, your at risk is becoming zero. Now all these calculations we don't have to do manually. Again, like this is all done by our softwares. But we need to understand, this is more important from tax planning perspective. We need to understand that okay, if last year our taxpayer has claimed $50,000 losses because the planning was not done properly, or his amount at risk or basis got decreased and all. I mean, can you imagine that last year of $50,000 will come this year as a taxable income? It's not even an income, but it may have a very detrimental effect on the tax return. Because what they're saying is previously allowed losses must be recaptured as income. So we need to, this year in the tax return, then we'll have to put, okay, these are previously allowed losses. Now the taxpayer, probably the taxpayer took advantage of those losses last year, but now they're coming back as an income. Whatever advantage was given last year is all gone now. So again, the bottom line is, let's not get confused. The bottom line is, whenever we are working on LLC, S corp, partnership return, let's keep an eye open on the basis calculations. Let's not just take profit and loss number, put that this is revenue, this is income, this is expenses, whatever, and I'm done with return. The capital account of those partners is extremely important. The capital account will tell what is the basis and all. Okay, all those things. Okay, let's go over these two examples. So, Bhavani, go ahead.
Katie purchased a small apartment building for $200,000 using $25,000 of her own money and $25,000 borrowed from her father to make the down payment. She signed a note to pay the remainder of the purchase price to the seller. The debt to the seller was...
1 minute. She signed a note to pay the remainder. What does that mean? The moment when they say note, they mean promissory note, not like a note which you write on the piece of paper and tell, like, okay, here, take this note. We're not talking about that. Okay, we need to understand what they mean to say. She signed a promissory note. That means it's a legal loan agreement that she will pay the remainder of the purchase price to the seller. So that means she's taking a loan from the seller. Right? She's not paying it. She's signing a note that in future I'll pay. Okay, go ahead. Sorry.
The debt to the seller was non-recourse, secured only by the apartment building.
So 1 minute, stop. Non-recourse. Okay, Shweta, can you tell me why this is non-recourse? The debt to the seller is non-recourse. What is non-recourse and recourse?
Non-recourse is where the person is not personally liable. Taxpayer is not personally liable.
Right. It doesn't get recourse to their personal liability. Yes. So it's a non-recourse.
Secured only by the apartment.
That's why they're clearly saying that it is secured only by the apartment building. It is not secured by Kathy's other personal assets. If she defaults, then the seller can come and take the building back. Right? It's not like the seller will come and say that, okay, now I need your car also, I need your bank balance also, everything you give me. Why? Because you're not paid my loan.
It's a non-recourse.
Non-recourse. Okay, go ahead.
Katie is not at risk for the loan from the seller because the seller is a person from whom the taxpayer acquired the property.
Right. Okay, Anurag, you want to read this?
Mooch purchased rental real estate with some money borrowed from his mother at commercially responsible terms, and the
Yeah,
rest of
stop. 1 minute, huh? 1 minute. Sorry, I'm like interrupting. But what they're saying is borrowed some money from his mother. So this is from a relative, from a related party, but on commercially reasonable terms. So they borrowed from his mother at commercially reasonable terms. Okay. Go ahead.
and the rest of the money borrowed from the seller. Both loans were non-recourse and were secured by the property. Mooch is risk for the loan from his mother because of the commercially reasonable terms, and non-recourse loan is for real property. Regardless of the terms, Mooch is not at risk for the seller's loan.
So seller is a third party. There is no risk here. It's a non-recourse and all. But what they're saying is the financing is even if it's a qualified non-recourse financing, but if it's taken, there are certain points that they have given here. If it's taken from a related party on commercially reasonable terms, but on commercially at commercially reasonable terms, then again the person will be at risk for the loan. So when we are, we have to understand that the property has completely secured the loan. So for a third party, that's not a problem at all. But when the money is coming from a related person on commercially reasonable terms, again, the person is at risk for that loan. Okay, this is a bit confusing, I know, but then the seller's money is attached to the property. Okay, the other money which is being taken by mother or father and all, that is again the mooch is at risk for the loan. So when if that property is used for any LLC or partnership and all, we'll have to put that $25,000 is at risk, and rest of them is a non-recourse. Rest of them is not at risk, but the entire loan is non-recourse. Okay. So what they're saying is non-recourse is generally excluded for the amount at risk, but there are certain conditions when it is still non-recourse, but it will be considered as at risk if certain other conditions are satisfied. And especially when we are talking about real estate and all those things. Okay.
Ma'am, one confusion. There's one confusion.
Go ahead.
Ma'am, in the work example, non-recourse debt 411, she signed a note to pay the remainder. So does this mean she has given the guarantee?
She signed a note to pay the remainder. So what she's saying that I'm going to pay it later, but she has not given any guarantee. She's not saying that okay, if I don't pay this, you can come and take away my other property and all. That loan is strictly against this building that she has bought.
Okay.
Like take that as an example when we go and buy a car on lease and all. Right? If the person is not able to pay EMI, what will the financing company do? They'll come and they'll take away the car.
Yes.
That's the worst that they can do, right? That's we are not putting there in the agreement that okay, you can, besides the car also you can come and take away my scooter as well.
Yes.
Right? Yeah.
Okay.
She's also signing a note only to pay the remainder to the seller.
Okay, ma'am. Okay.
Yeah. Okay, we'll stop here.